Hey everyone, Rob B here with Rob D. And we've understandably been getting hammered with your questions. So this week we tackle the biggest of those questions. We cover interest rates, mortgages, property prices, and so much more. It's going to be a must listen.
Welcome to the Property Podcast, where every Thursday morning, Rob and I take some time out of what we're supposed to be doing, which is advising a multi-million pound property fund, which you can read about at portfolio.co.uk, and putting together transactions for our clients. And we bring you some of the knowledge that we've gained along the way. And hopefully, spending as long as we have in the market every day, seeing what's going on, thinking about it, talking about it, puts us in a decent position to answer some of the big questions that you've been sending our way. So coming up, those questions. The 18-year cycle, is it broken? House prices, will they crash? Interest rates and inflation, how high will they go? Mortgages, what's going to happen next? And finally, the biggest question of all, what should I do? We're going to be answering all those questions for you in this episode, so don't go anywhere. Let's start with this week's news. Another week, another Prime Minister. We've got another one. It's like the last couple of months didn't happen and Rishi Sunak is in power. Or at least that's what the Conservative Party is probably hoping to be the case. Rob was ranting on the podcast just last week about the need for a united government, and hopefully that's now what is going to happen. In terms of actual policies, I think it's going to be more of the same. Liz Truss was trying to do something different. That didn't work out. And now we're going to go back to something that seems a lot more familiar. But in terms of what is going to happen, what's going to be announced with policies regarding taxes, what the new Prime Minister and his cabinet decide to do around some of the property policies that have been bubbling away in the background for a long time. Are they going to get on with some of those now? We'll have to wait and see. And of course, we'll keep you updated right here, starting with our market update episode, which is coming up in a couple of weeks' time. So make sure you are subscribed to the Property Podcast and we'll tell you everything you need to know as it happens.
So we have 5 big questions for you today, but you may have a 6th question, and that might be, I love property that much that I would love to subscribe to a really high quality, well put together magazine on that subject. But Rob, I'm stumped. Can you come to the rescue?
Of course I can, because the Property Hub magazine is going to be hitting doormats very soon. So if you're already a subscriber, then you can look forward to enjoy reading about subjects like how to handle a rent rise, how to do it the right way without alienating your tenants, which is obviously very topical at the moment. The cover story is about refurb-based property strategies and how that's stacking up with the cost of everything going up. And everyone's favourite thing about the magazine, the case studies. The magazine is perfectly suited to sharing case studies and real investor stories in a way that it's more difficult to do on the podcast. So you can read about an HMO conversion, a renovation project, and more. So as I said, if you're already a subscriber, that's going to be landing with you very, very soon. If you're not, then you can still read all that, because when you sign up, you not only get all future physical actual paper issues, but you can also go and see digital copies of every previous edition, and there are 37 of them now, so the value of that is just building and building. And forget what you hear about inflation, because we've never put the price of the magazine up, I don't think, in like 6 years or something of doing it. It still works out at just £5 per issue, including getting it posted to you, which is insane. So if you do want to sign up for that, just go to propertyhub.net/magazine and you can do so there.
So we have our big 5 questions. And the first question, is the 18-year cycle broken? It was looking pretty good, but there's been a lot of turmoil. So people are now starting to say, oh, well, the 18-year cycle is definitely broken. And I've seen the comments, and people are pretty confident in that. Rob, do you share that same sentiment? Is the 18-year property cycle now broken? Do we rip it up and look at a new economic model, or can we still have faith in it, especially after what's happened recently?
Well, we haven't talked about this between ourselves yet, so I'm interested to hear what your view is. But mine is is it broken? In the most important sense, no. In that I don't think that the crash is coming early. And that kind of spoilers to a degree question 2 when we're going to talk about house prices, but actually there's a lot more subtlety to what we've got to say about house prices. But in terms of the crash happening, everything falling apart, having to build up again after 4 years of declining or flat prices, no, I don't think it is broken, because I don't think that's what's going to happen. But I do wonder if it is being a little bit unhelpful. Because in that stylized model where you've got 14 up years and in the middle of that you get your mid-cycle dip, that to me is something that I don't believe we've really seen in this cycle so far, because it was already looking a bit iffy. We may get another dip again now. So Rob, keen to hear what you think. But for me, broken, no. Stretched a bit in terms of how you can kind of pinpoint your position along it. Yeah, quite possibly.
I mean, I think this needs some perspective. It's not called the 18-day cycle. It's called the 18-year property cycle. And 1 or 2 months within an 18-year cycle doesn't then dictate how everything's going to go. Now, if these days and months turn into a year or two, then I think you can say the 18-year property cycle is broken. But what does the 18-year property cycle expect us to see at this time? Well, over the coming years, it expects a boom. Now, you can have different versions of a boom. You can have a crazy boom or just a normal style boom. Last time around, we had a bit of a crazy boom. But whether it's a crazy boom or just a boom, it's still a boom. And will we, over the next few years, see property prices increase at a faster pace than we have over the previous few years? Well, I think the answer to that, and it's going to make me sound a bit crazy at the moment, especially with all the turmoil, I think the answer is yes. And that's because through a lot of the last few years, so ignore this sort of last 18 months, up until then, property prices have been growing in low single digits. More recently, it's been close to breaking double-digit growth, which is clearly a boom. Will we see growth next year? We've got our predictions episode coming up soon, but we've still got time to think about it, plan, and really consider the question. But if you're forcing me today to say, will property prices end up or down next year? I would say up. By how much? That's a question I can put off for a few more months until we make those predictions. But ultimately, I believe in the cycle, and I believe that this government will want to show growth over the next 2 years to give it a chance of winning the next election. They may not be as reckless with that pursuit as they have been over the last 30 days or so, but they still want to achieve that. They don't want to send us into an economic downturn for the next 2 years because they will get absolutely slaughtered at the ballot box. So they are highly motivated to turn this around in the short term. So because of those motivations at play, because of all the money that's in the system already from all the QE that we've had, I believe that we will see a continuation of the 18-year property cycle. How aggressive that will be, time will tell. But will we still have an 18-year property cycle? And will we still see property prices grow over the next few years? Yes, I really do believe that.
There's a YouTube video that we put out a few weeks ago that we'll link to in the show notes and I think is well worth going and having a look at. Because it kind of makes the point that the 18-year cycle isn't as useful as it should be. Because what we both appear to be saying is, yes, we believe it does have predictive value still. We do believe that this cycle is going to play out broadly as previous cycles tell us it will. But the whole point of knowing about the cycle is it should allow you to do something with it. You should be able to take advantage of this. And the way to take advantage of that is to not be active in the market at the wrong times and to be very active in the market at the right times. And the right times is when there is growth still to come and everyone else is panicking and there are good opportunities out there. But I see so little evidence of anyone actually using it for that purpose. Because every time anything happens that seems to be threatening the model, all we talk about is it broken? Is it really going to work this time? The very, very, very few people I'm aware of who actually use the 18-year cycle to take action because they have enough belief in it. So I think that video is well worth a watch. Because to me, there's only any point to even talking about the 18-year cycle if you dig into what underpins it, why it's a thing, what the economic forces are that have caused it to happen in the past and should make it continue to happen in the future, so you then have enough belief in it to actually use it. If you don't do that, you just count forward 18 years on your calendar and go, oh, well, this should happen then, but it doesn't look like it's going to happen, so will it? Then it's just another talking point. It's just another distraction. And I don't think there's a lot of point to it.
Okay, so let's move on to question 2, which we've started to answer, which is, will house prices crash? Well, I don't think you're going to get any awards for realising that we both think the answer to this question is no. But Rob, possibly the more interesting question is, will property prices fall in the short term?
Well, let's put this against what we're seeing headlines about at the moment, which is of falls to 10 to 15%. I really struggle to see that. I get the fact that prices on average have come up really quickly. So to put it into context, a fall of 10% wouldn't even set the market back a year. And that's pretty crazy. So you could certainly see from that perspective how that could happen. It's like, well, it went up really quickly. Now things have changed, so it will come down really quickly. I kind of get it. But at the same time, that is still a really big fall, especially in real terms.
And I think that would be classed. I mean, we have to stick our necks on the line here, Rob. If we're saying no crash, anything of double digits has to be categorized as a crash, because we're saying that double-digit growth is a boom. So therefore, a double-digit fall is a crash. So if property prices do dip by 10% or more, then we're wrong.
Yeah, I think that's fair. And the average always conceals a lot. I think there are going to be big variations of what happens between parts of the country and different property types, and we can come on to some of that. But the overall effect is, well, what do we know is going to happen? Well, we know that transaction volumes are going to fall. People are going to be sitting and waiting to see what happens. They're going to be nervous about taking out mortgages. People are not going to be putting their home on for sale while they don't know how the market's be. So transaction volumes are going to fall. The only people who are listing properties are going to need to sell. That suggests that you'll be able to do discounts, and that suggests that it'll pull the average property price down. So will we see the rate of growth slow down? Definitely, I would say. Will we see prices fall? Possibly. Will we see them crash? I don't think so.
I wouldn't be surprised, because of the low transaction volumes, that we see property prices fall slightly. But bring this back to question one, the 18-year property cycle. If they fall slightly now, then this year will still be positive, because people have seemed to have forgotten already that we were in the middle of a boom until all this kicked off. So because they've come up by such a long way this year, a fall of a couple of percent won't make a difference overall. Overall, this year, if in 10 years' time, if you look back at it, you go, oh, well, 2022 was clearly a good year for property. You will. I know that sounds crazy right now, but in 10 years' time, if you looked at a chart and you've forgotten about what was happening when, you'd think that 2022 was a really good year by looking at property prices. Next year, the beginning of the year might not start off that strong, but overall, will we at some point kick back into growth and end up in a positive next year? Yes, and I've already said that. What I think is interesting is the question of by how much. Is it going to be weak growth next year, or is it going to be strong growth next year? Because we're going to talk about the economic conditions that will determine if we get growth or not in a little bit, at least some of the contributing factors. But overall, property prices this year will be up. It's going to take something monumental for that to change. Monumental. And we haven't got much of the year left, and we've had quite a lot of monumental stuff happen over the last few months. So the chances property prices will be negative in 2022 are very, very slim. It's a high probability, an extremely high probability, that property prices will end up this year. And that's why it's important not to focus on the immediate short term. If property prices dip a couple of percent, the media is going to go absolutely nuts. They're going to love it. They're going to be doom, gloom, property prices crashing. 2% isn't a crash, but they'll call it a crash, and it will whip people up into a frenzy. While this may be scary for some, possibly many, we've talked last week about how it's also an incredible opportunity. Rob and I are buying right now. Many of our team are buying right now. We're more active now than we have been in any other point of the year. And the important question is why? And the reason why is it's easy to do a deal right now. If the market drops by a couple of percent, but you can get a deal that gets you 12% off the fair value, then I don't really care if it drops 2%, because I've got that huge buffer and I'm buying well. I'm buying good quality properties at a discounted level that I'd not normally be able to achieve. This market allows that opportunity. Now, it's hard to do if you focus in the wrong areas. People who are listing their own homes are going to be reluctant to do that unless they have to. The opportunity, I feel, over the next few months, and I think it's a short window, is around stock that's coming onto the market because it's just being completed or is off plan, and developers are nervous about what their prospects are going to be like when it completes. And like I said last week, you don't need to use Property Hub Invest. There are lots of ways you can do this yourself. You can just search for new builds on Rightmove. So this isn't a thinly veiled plug. It's just a strategy that you can deploy for free. You don't have to pay us. If you want to leave a nice review, feel free if you get a good deal. But the deals are there to be done. I don't think it'll last long, but they are there right now. And that's why we're so active. And that's why we kind of get louder when people are more fearful. And if you've been listening to us for a long time now, you would have noticed that this is a common pattern of behaviour for us. That when people are fearful, we get alert. We sharpen our senses. And it's not something that we've developed as a strategy. This is what the best investors in the world do. There's a quote from Warren Buffett that's often bandied around at times like this, and it's when others are fearful, be greedy, or be greedy when others are fearful. You get the message. The message is that this is an area of opportunity. And it's up to you to decide whether you take it or not. You don't have to, because you might disagree with us. And you know what? I think it's important to say we don't know. Nobody knows, but all we can tell you is what we believe and what we're actually doing. And I think that's a lot different between us and a lot of other commentators. Is a lot of people are quick to say, oh, I think the market's going to crash, or I think it's going to boom. But if you think the market's crashing, are you selling everything right now? Because if you believe it's going to be 10% cheaper in 6 months, surely you're going to sell everything and buy back in 6 months' time at a 10% discount, if that's what you truly believe. If you believe, like us, that the market is an opportunity, then you should be taking advantage of that opportunity. Be wary of the commentators who spout out the scare stories, who don't seem to do anything with it. It's easy to make a big, bold statement. Only a few make the big, bold statements and then follow up with action.
That's right. And for me, it's not even about being greedy. It's just about not being bothered that much. Most of the time, what happens in the short term just isn't important. Okay, there are stories from the last crash of people radically overpaying in certain markets, especially overseas property and things like that. And that did cause them major problems. But most of the time, if you're not getting really carried away, then it just doesn't make that much difference. So we both agreed a purchase last month, I think it was. If prices have come down by the time we complete, am I bothered? No, not at all. It doesn't make that much difference because, well, I'm not going to turn around and try and sell it immediately, am I? So what it's worth doesn't make the slightest bit of difference. My existing portfolio, I mean, who knows what it's worth? It's hard to know from day to day, but let's just say that it's up 10% on where it was a year ago. Does that matter? Well, no, because I'm not planning on selling any. So that doesn't feel any different. My stock market portfolio, I haven't looked, but it's probably down by more than 10% on where it was earlier in the year. Does that feel any different? No, because I'm not going to sell that either.
You know what, Rob? That's a really interesting point. There's been so much going on in the world. I hadn't even considered my stock market portfolio because, of course, it is down. And while I can honestly say, and I truly, truly mean this, I've not looked to see where it's at right now. I have been looking at some stocks that I think are interesting because they've become quite good value. So I don't know how down I am because I'm not selling. I have no intention to sell, but I am excited that I can get some stocks at a cheaper price than I could have 6-12 months ago. And I think it's quite liberating when you start to move your mindset to the long term rather than the short term. Of course, if you're about to retire, then fair play. I can understand why right now would be a scary time because every movement could make a massive difference. But if you're in your 20s, 30s, 40s, 50s, you should not care if your stock is down 20%. And like you say, Rob, nor should you care if property dips a couple of percent. Most of us, the vast majority of us, should be taking the long-term view.
Yeah, and because with property, it's far more difficult to time the market because you can't just have a little dabble here and there. I think there's even more reason for having the long-term view. Even with the stock market, you probably shouldn't do it, but it's tempting to go, oh, well, I'll wait and see if it comes down a bit, and then I'll buy a bit more, and then if it falls further, I'll buy a bit more, keep bringing my average down. With property, everything's so lumpy and slow to move, you basically can't do it. So you have to take a long-term view, and that's why I think it's best to think, well, where's my portfolio going to be in 10 years, 20 years, or whatever, and just get on with that and deal with whatever the market does along the way.
The third big question, and these all are big questions, is around interest rates and inflation and how high will they go? Well, they will go higher, and we're both aligned on that point. How high is really interesting? Because a week or two ago, the markets were pricing in interest rates of 5.75% in the future. Big, scary numbers, right? They have now come down to 5%. So in the space of 2 weeks, it's dropped by 0.75%. And that's partly because one of the members of the Bank of England committee had come out and said, you're pricing this in too high. It's unlikely to go above 5%. So the Bank of England are looking at what the market's doing and going, guys, you're more pessimistic than us. So the market's overreacted. And now it's priced down. And I wouldn't be surprised, Rob, if it continued to come down. Because while we have inflation, and inflation is very high right now, the reason why interest rates are starting to soften, future predictions of interest rates at least, is because people's expectations of inflation are starting to calm down as well.
Yeah, it's all about inflation. And inflation is really hard to predict. And I've been wrong about interest rates this year. And I've been wrong about interest rates because I was wrong about inflation. I didn't think we were going to see inflation anywhere like the levels we have. I thought we might get inflation of sort of like 5% or so. And that's the sort of level where it's actually quite helpful to the government and no one pays that much attention to it. And you can start moving interest rates up a bit, which is a good thing to do anyway. And arguably they should have been doing earlier, and you're all good. Inflation has actually been much higher than that. As a result, very late to the party, they've acknowledged that it is and started increasing interest rates rapidly. But what is the path of inflation from here? I mean, acknowledging that I don't know and nobody knows and it's really hard to predict, and I've already been wrong before, I do think inflation is going to come under control and the rate of inflation is going to fall relatively quickly. And I think there are probably two main reasons for having that position. One is that inflation is expressed as like a rate of change over time. So we've already had loads and loads of price increases for reasons that you can point to, including energy, Ukraine, money printing, which we'll come to. All these things have happened. And therefore, purely because of base effects, the rate of inflation will come down. The counterpoint to that is that it's kind of embedded now. And so people are going to be asking for higher wages and wages will push everything on. Maybe that will happen. But the other reason is the money printing. And I believe the main reason for the inflation that we're having at the moment, yes, there are other factors, but the main reason, which tends not to get talked about so much, is all the QE that happened in 2020. That's taken some time to work its way through. But the rate of money growth, which did have a huge spike in 2020, is now flat. So that's happened as well. That's another of those big factors that's in the past and is now working its way through. So for those reasons, I think inflation is going to come under control kind of regardless of what the Bank of England does anyway. Because I'm not actually convinced that fiddling around with the base rate makes that much difference anyway. And as a result, they're not going to need to take interest rates as high as the markets currently believe. That was a big, long speech, and I know that there's no evidence for this at the moment, and you're looking at inflation of above 10%. It had another big jump in the numbers just a couple of weeks ago, and go, how can you possibly be saying this? I don't know. We'll see.
We will. But for what it's worth, Rob, I agree. I don't believe this government wants to crash the economy. And people are rightly saying that if interest rates go to a certain level, it will crash the economy. It will. You don't have to be a prize-winning economist to get to that point of view. So you hope that our government will get to that point of view, and the Bank of England will as well, because that's not in anybody's interests. So will interest rates go up from where they are right now? Yes. Probably the easiest prediction I'll make today. But will they keep steaming ahead? No, I don't think they will either. I think they will soften. I think inflation will soften, and therefore the desire for interest rates to keep going up and up and up will soften as well. And so with inflation calming down a little and no strong desire to wreck the economy by ramping up interest rates to an unsustainable level, I think those two combined will mean that it's not going to be as scary as some people have predicted. But Rob, it's easy to see why people are predicting financial Armageddon, because on paper, interest rates are actually historically really low right now. If you actually look at it, they are very, very low. Yet some of the mortgages being offered are really high when it comes to the rates, like scary high, that it means that it just doesn't stack. So our fourth question is around mortgages. And what should be people doing right now?
Well, again, I'll refer you to a YouTube video that we put out recently. I will link to it in the show notes, because that explains the reasons for this sort of seeming disconnect about the fact that interest rates are still actually pretty low, but mortgage rates are really high. Or to put it more accurately, fixed rate mortgages are really high. And that is really the key, because fixed rate mortgages consider the future. And the future, as we know, has been pricing in these big increases that may or may not happen. Variable rates are aligned to the base rate, which is still low. So of course, higher than they were. There was a time when you could get a mortgage for less than 2%. Now, believe it or not, there are variable rate mortgages out there for less than 3%. That's not something you hear very often, but there are. But even if those rates go up, which they pretty much certainly will, because as we've just said, interest rates will certainly go up, it's still a long, long way off the big numbers that you're hearing right now. My personal answer, and it can only be personal because everyone's circumstance is different, would be keep your options open. Unless you really, really, really need the certainty, stay away from fixed rates, because I think they offer really poor value at the moment. But I think you put it best when you said it on the podcast a few weeks ago, and I think that still applies, which is, if you can, do nothing at all.
Yeah, if you can do nothing, it's worth doing nothing, because the amount of products on the market right now is also reduced, because the lenders just don't know how to price their products, so they keep withdrawing them from the market. So if you can let things settle down, if you're in that position, then do so. Now, even if your product has expired and you're having to pay a slightly higher rate for a month or two, it's still probably worthwhile holding off. So if you can, right now, do nothing, except watch that YouTube video that Rob's referred to, and that'll give you even more confidence in what you should be doing. Which leads us nicely, Rob, into our fifth and final question. What should property podcast listeners be doing? It's all well and good understanding our points of view, but sometimes people just like direction. Well, we will try and guide you, but as Ed mentioned earlier, we could be wrong. We could be. We've got quite a good track record on the property podcast, I'm pleased to say, because when you document your thoughts for 10 years, the chances are you're going to be wrong occasionally. And we've built up a lot of trust with you over the years because we have been able to get a lot right. But we could be wrong this time. At some point, our luck may run out. So I do want to caveat that this is not direct advice to tell you what to do, but it's to say what we would do in these scenarios, and then you can decide for yourself. So first of all, Rob, let's look at the scenario of somebody who's in the middle of building their portfolio. What should they be doing right now?
Well, this is relatively easy because that describes us, and we've already said what we're doing. But while we're still building our portfolios, in that I expect I'll have more in the future rather than less, we are still quite a long way into it. But I acknowledge that if you're at the very start of building your portfolio and you're not that far into it, then it is more scary. So, Rob, what advice would you have there?
My advice is always to go back to the long term, because for the vast majority of people who invest in property, this is all about the long term. Let's just say we're wrong and the market crashes. Doesn't really matter. Like with shares, it doesn't matter over the long term because property prices will recover and then go back up again. You will be paid rent through that period. The rental market is ridiculously strong, something that's not really talked about, but rents are going up and up and up at the moment. So you will get paid while you own that asset. On paper, if it crashes, if you didn't get yourself a deal and you didn't buy it at a discount, then you may be in a negative territory. But unless you sell, it doesn't matter. So don't ever sell when the market crashes. That's the worst time to be selling because the market only crashes for so long and then it'll recover. So if you're of the opinion that now is a good time to buy, but you're still a bit nervous, be reassured by the long term. You should always be reassured by the long term. So don't miss out on the opportunities and your beliefs that the market is a really good place because of a niggling doubt of fear. Because actually holding back and not doing anything at all is normally the most costly thing you can do when it comes to investment, if you're doing it for the long term. Sitting out for a couple of years could cost you. It's going to cost you rental return, absolutely. But if the market doesn't crash, then you've really missed out. And if it does crash, well, you'll be looked after again in the long term. But getting started with a portfolio is the start of you changing your financial life. And for me, unless you're really confident a crash is about to happen, for me, it's something you should always aspire to do. So what about people, Rob, who have agreed to buy something maybe a few months ago when the market was red hot, are still in that process of buying it, and now we have a load of uncertainty and mortgage rates at higher amounts? What should those people be doing? Because this is another question that we're being asked a lot, which is, what should I do with this particular purchase that I'm in the middle of going through?
Well, the good news is I think there's hardly anyone who's going to be buying something at the moment that they really, really shouldn't be. And that links back into the 18-year cycle and links back into why we don't feel that we're in kind of crash territory. Because if you think back to last time, if you can remember back that far, it was sealed bids all over the place. People were paying way over the odds. People were paying anything just to buy something. People were going into very, very risky off-plan deals. And recently, we just haven't seen any of that. So, of course, all this uncertainty is going to make you look at your purchase in a new light, probably a more realistic light, because you're not basing everything on things being wonderful all the time. And there are some transactions that will look less appealing as a result of that. So, for example, I have heard the odd story of people going to sealed bids on their own homes if they're wanting to go and buy family houses in nice leafy areas, like a 45-minute commute out of London with a nice garden and all the rest of it. Basically, the exact type of property that had the post-pandemic boom. Those are the ones that are probably going to be the most vulnerable to prices falling, because they're the ones that have had sort of the irrational exuberance, I'd suppose. For anything else, it's probably not going to make that much difference. If you're buying with a buy-to-let mortgage, they will have been stress tested at higher rates anyway, so you couldn't be going and getting a mortgage at rates that don't make sense. Obviously, at rates of 6%, even 8% I've seen for some deals. Obviously, there's a lot of transactions that won't make sense at that level. But as we just talked about, that's not the level where we believe we're going to land anyway. So I'd say if you're in the middle of buying something and you haven't arranged a mortgage yet, unless you really, really, really need that certainty, keep it as flexible as you can. If you're buying something that only works with this one really, really cheap mortgage product that was available that one time, and the rent just about covered the payments at that low level, but you believe there's going to be strong capital growth in the future, so it's worth it anyway, in that case, you should probably be looking again, because that probably isn't something you should have been doing anyway, but it's the kind of thing people do when they get carried away. But otherwise, go back to your numbers, reassure yourself, focus on the long term, like you just said, Rob, and carry on. And I think the final what should I do scenario, Rob, is so you've already got a portfolio. You were happy with what you've got. You weren't planning on buying anything else. But now you got nervous as a result of everything that's happening and you're not feeling good about the future. And you think, oh no, maybe property has peaked. Maybe it's on its way down. What should I do? Well, it sounds harsh, but my advice in that situation, Rob, is, well, you're too late. As you already said, the worst time to be selling is when the market is nervous. And that's why, for me, if you're in. Your rents are likely to stay strong. Nothing to worry about there. But if you do want to be decreasing the size of your portfolio, don't panic and do it now.
Yeah, if you're a property developer, and I know a lot of you will be listening, maybe you can rent the properties out and service your finance that way. Or if you've just done a refurb, maybe you can put a tenant in and come back to the market in 12 months' time. It's not ideal if you're in a position of wanting to sell right now, as we've said, because it's a great time for those who want to buy. It's certainly a buyer's market right now. So a bit like with the mortgages, if you can hold off and not do it right now, do. Even if it costs you a little bit to hold off, it might be worth doing that. So they are the big questions answered. And hopefully now you've got more confidence to make a decision. It doesn't matter what your decision is. Nobody can tell you you're right or wrong, but the more informed you get by the right sources gives you a stronger chance of making the right decision. So whatever you decide, best of luck. So now it's time for Hub Extra, the bit of the show where we want to give you a bit more value. Like, we just can't stop. We've got to give you more. And we've talked about our YouTube channel a lot today. It's not the Hub Extra resource, but it is a YouTube channel. So head over to YouTube and subscribe to our YouTube channel. And then after you've done that, head over to the Never Too Small channel.
Yeah, this is really fun. This is one that producer Dan and I had both discovered independently, along with 2 million other people, so we're not trendsetters that much. We were talking about it the other week, and it's great. It showcases, as the name kind of suggests, micro homes. Not in the sense of living in a trailer or a treehouse or anything like that, but regular apartments that are just tiny. And the titles are great because it'll say something like Tokyo iconic 19 square meter house. You're like, no, it's 19 square meters. How is it even possible? And then you watch it and it always focuses on the design and the architecture and the decisions they've made about how to make a home that small work. There's always really cool little space saving things that they do. So while I wouldn't say that it makes me want to downsize and go and live somewhere that tiny, certainly not with my family, maybe if I was on my own, it is a really good watch. So Never Too Small is the channel and we will link it in the show notes.
Well, that's us done for another week. Thank you for listening. We've got a brilliant episode coming up for you next week, so make sure you join us. And with so much happening in the world right now, make the Property Podcast a must listen, because we will keep you up to date and help you make sense of all this craziness right now. And you'd be crazy not to join us on Tuesday when we have Ask Rob and Rob come out. So join us then. Until then, take care, have fun. Bye-bye.
Bye-bye.